All right, roundtable. I got a question at the end of today's session. Hey Mac, do you have a video titled How the Market Works? And while I've talked about this in a lot of different places, and I have a video similar to this, it is a couple of years old, and as we all know, everybody likes something new. So what I'm going to do is take a few minutes. I'm going to try and keep it to under 20 minutes and use a combination of the live market and then pause. I'll pause the screen and draw on it just to kind of give you an idea of how the market works. Now we are looking at the S&P 500 E-mini futures contract. This is a futures contract traded on the Chicago Mercantile Exchange. If you're not familiar with it, you can go to the CME.com and find out all about it. It's really not important what it is we're looking at. What's important is what's going on here. So there's a lot going on, and you've probably never seen a screen that looks like this, so let me at least explain a little bit. So let me freeze the screen right now. You can ignore this, and you can ignore all this. We're going to be focusing on just these two boxes here. This is the ask, and this is the bid. The top line represents what's called the best market, right? So if you wanted to buy, you could get 1351.50. If you wanted to sell, you could sell them at 1351.25. So we're looking at the live screen again. I want you to just notice, you can see the prices changing. In fact, let me see if I can format this window. All right, there we go. I wanted to make it a bit simpler for you. All right, so now we're looking at the bid and ask again. Here I've frozen the screen. This is the bid. This is the ask. If we wanted to buy, we'd get them at 1351.75. If we wanted to sell, we'd sell them at 1351.50. And of course, the difference between the bid and the ask is the spread. Now you can see this is a pretty active market. Prices are changing. The time is changing. This is 2:09 Eastern time. And you can see price was going nowhere for a little while, and now it's picking up. It started to move up. So the question is it not, how, Mac, does price move up? Well, let's pause the screen and take a look. All right, so the way price moves up is people who over here that are willing to sell, because someone has to sell to you, right? So what this really means is someone is looking to sell at 1351.75, 654 contracts. Now this doesn't mean that there are 654 individual people. It just means that that's how many contracts are available. The exchange takes all of the orders that are out there, they put them in a bucket, and they show us the total number of contracts. Now they do that for two reasons. One, something called price discovery. Number one, we know very clearly what the price is. Number two, we know very clearly how many we can get or how many we can sell at a given price. Let's go back to the live trading. So you can see price has gone up. Let's pause the screen again. All right, what we're looking at are people that are willing to trade at different prices. What we have to add into this mix is something called the LMM. Now, simply put, this is a market maker who, in exchange for better fees, execution, they get benefits for this. Their job is to make sure that there's always somebody to trade. So when the market's moving up like this, because people are buying, what the exchange wants to do is to maintain the spread, right? You see 1351.75 by 1352. That means the spread is 0.25. Now, if you're familiar with the Forex market, sometimes you've seen the spread go to 10 pips in the pound, 15 pips in the pound. That's because there's no LMM. There's no market maker. There's nobody that is designated, that's picked, that's chosen, that volunteers to make sure that the spread is always 0.25. So let's do some pretending here so we can understand how prices moves. Let's look at the live market again. You can see, okay, price moved up again. Gosh, Mac, how is this moving up? Well, if we watch this for a little while, and you see we've got 52 by 52.25. All right. So if we bought right here 1352.25, you've got to realize that in order for price to move up to, let's say, to 1352.75, where we've only got 50 cents worth of profit, look at how many contracts have to trade. Over 1,400 contracts have to trade. Now, I want to, I'm kind of pausing to let this sink in. See, this is where most retail traders really just kind of let their eyes glaze over, Mac, what are you talking about? Once again, if we buy at 1352 and we want to sell at 1352.50, you notice the contracts have gone down, but it's still 2,000 contracts. 2,000 contracts need to trade for price to get to 1352.50. You can see it's jumping around. Now we're a little bit closer, right? So what does it mean now that price has moved up? Well, it means that all of those contracts that were at 1352 even have been traded. And then now we've gone to 1352.25. So again, I'm just letting the the live market play out. So in order for 1352, if we had a limit order to sell, 1352.50, 400 more contracts need to trade. Now, you got to get this. 455, 56, all of those contracts have got to be filled. They have to go, or they have to be taken off of the market. In other words, those people have to cancel their orders. So now, what you want to notice, look, so this is staying about the same, 400. This one is going down a little bit. So it does look like there are more people buying. So we're holding on to hope right now. Okay, it looks like more people are buying. The bid is staying the same. Uh-oh, now the ask just went up. So it looks like more people are looking to sell. Remember, let me pause the screen quickly again. If we buy over here, who are we buying from? We're buying from a seller, right? And if we sell over here, who are we selling to? A buyer. Okay, so the ask represents their 500 contracts to sell. The bid represents 400 to buy. I mean, look, you've got to get this if you really want to understand how the market works and how price goes up and how price goes down. Now see, look, it's right back to where we bought. Oh, it's under where we bought. Oh, now it's back up. You see, price is just kind of bouncing around. Well, why is it bouncing around? It's bouncing around. Let's look over here. There are fewer people that are willing to what? Sell. Or excuse me, fewer people that are willing to buy. Sorry, I'm trying to talk fast and react to whatever's going on here, so I apologize if I misspeak. So if this is where we sell, right? We sell on the bid. That means there are 300 people that are willing to buy from us. There are 800 that are willing to sell to us. What that means is if this number is going up, that there are more sellers. If this number is going up, there are more buyers, right? Okay. So you can see, all right, that's gone down. So you see how we've got this tug of war, don't we? There are more over here, more over there. Now they're about equal. It's up and down and up and down. Okay, so this is how price actually moves. When you are looking at, this is called a market depth, you are witnessing what has to happen in order for price to move. So if price is going to go up, remember, say we bought at 1352. We're not making any money, right? In fact, if we sold, we'd actually lose one tick. So if we've got our limit in to sell at 1352.50, we want to make 50 cents worth of profit here. Look at this, 2,700 contracts have got to trade before we get our money. And actually a little bit more now. Look at that, 1351.75. Why is price moving down? Because these are getting filled. Right, more people are filling over here. All right, so let me pause. So what happens when all 615 of these go away? Is there just a vacuum there? Well, what happens is something that the exchange is going to call order matching. Let me pause this. Okay, order matching. You can go to your broker's website. You can go to the CME website and check this out. There's something called first in, first out. When an order comes in, it gets a timestamp. You can see that right there. It also has a price, where the order wants to get executed, and a size. So what you're seeing here are all of the orders at one price. Now these are all going to come in at different times. At the same time, the market is only going to fill, meaning it's only going to execute orders based on what comes in. In other words, people have to actually push the button. All these represent, these numbers here and these numbers here, all they mean are people out there that are willing to do business. So there are three parties there are three different people that we're talking about. We're talking about people that are willing to sell on the bid, people that are willing to buy on the offer, and then there's you or whoever is going to actually execute the transaction. So why does price continue to go up? Because a bunch of yous are pushing the buy button. That's it. So let me erase some of the drawing, clear it up. So if as the orders come in, they're buying orders, these 225 get taken out, meaning they disappear. If people keep buying, then these start disappearing, and these, and then these, and then these. Now remember, we talked about the market maker. Now, if everything just stayed the same, right? Let's say the only thing that was happening were buy orders were coming in. Then we would have this big difference in price. Or let's say all of these orders, all these contracts got taken out. Say a huge order hit the market, 5,000 contracts to buy, and all of a sudden the ask is at 1352.50. What the CME does is it has the market maker, the LMM, that is willing to not leave price behind, right? If we left price behind, then we'd have 1351.50, or a difference of 1 whole point. The LMM steps in and puts a price in there, so that if someone says, hey, look, I want to sell right now, they put in a market order, the LMM is the one that's going to take that order. So let's talk about your Forex broker and how this works. When you're trading with your Forex broker, they are the market maker. They're the LMM in this case. So let's use these prices as an example. Let's say in the Forex market, all of these got taken out. Okay, so then price would be trading up. You can't hardly see that. Price would be trading right here at 1352.50, right? That's where it left off, because all of these orders got taken out. Now, since your broker is the LMM, it's up to them to decide. 1351.50 is still the price over here. So they get to decide if they want to push price back up or if they want to leave the spread that big, 1 full point. This is why on news days you get these big spreads in the British pound, because it's up to your broker to move the spread or not. Now, when you're trading with your broker, some brokers will have this thing that's called depth of market. It looks like this, and some won't. If you want to find out, call your broker and ask, do you have an order book? Do you have an electronic order book, and can I see it? All right, so this is market depth. This is MB Trading. I'm not recommending them as a broker. I'm simply pointing them out. Here you can see the market depth. Now this is for the Aussie dollar. It's a fairly active pair. So we should be able to get a similar action to what we have on the S&P 500. Which, by the way, let me move this out of the way. So if we bought up here, let me pause this. Okay, so if we made the trade and we bought up here, you can see price is now down here. Well, how did it get there? It got there because more orders are coming in to sell. Pure and simple. That's how it got there. Now, if orders come in to buy, they will be executed first in, first out. But again, if these orders are getting taken out first and price is moving down, the exchange, in order to keep an orderly market, has the LMM step in to move price down on the opposite side. What the heck what are you saying, Mac? What? What? Okay, so price is moving down. It means these are getting taken out. These are getting taken out. So price is going down. People are selling. They're hitting the bid. Sell, 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 sell. Well, again, the market doesn't want to leave this gap, 1350 to 1351.25. So the LMM steps in. Price automatically moves down, and these orders are still there. And if price gets back up there, yes, they'll get executed first, but price simply moved away. All right, let's go back to our Australian dollar. Here we go. Same thing over here. So as I'm looking at this on MB Trading, I can see 1.02251, 1.02269. Here are the trades, right up there at the top. There's the last one. Oh, excuse me. 1528. No, they're coming in at the bottom, I believe. I just updated my software and that looks like that changed. So this over here are the orders that are streaming past. Okay, these are orders as they get filled. There's 50 on the ask, 100 on the bid. 102269. See that right there? 102252. These will be the trades as they go across. I can see the spread. I can see the lowest bid. I can see when the last tick happened. I can see prices going up and up and up and up. So this is how price goes up. Let me pause the screen again. So just count them. 1, 2, 3, 4, 5, 6, 7, 8, 9 on the bid. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 on the offer. There are more trades at the ask where people are saying buy them. These get executed, then these, and then these. And then it's up to the broker to pull this price up. Otherwise, the spread increases.
It's 12:30.
Let's go back to the S&P 500. So price is moving down. Mac, how does price move down? It moves down because the market is getting more. Look at that. It went from 1,000 down to 50. I mean, it flashed by really, really fast. And if we wanted to see, let me bring in, where's my time and sales? There it is. Let's put it. Okay, so this might drive you crazy. These are, look at this, all the trades that are getting executed. Look at that. So every trade that goes across, okay, look at that, at the ask, at the bid. Okay, now if I scroll back, oh, it's not going to give me the history. All right, look, so all these are at the ask. Bunch at the ask. You can see price was going up. Just a few at the bid, a few at the bid, they're hitting the offer, so price should be going up. Oh wait, price is going down. Look at that, boom, sellers. A bunch of sellers came through. But then look over here, you've got a lot of contracts. Lots of people looking to sell over here. Not so many looking to buy. So it's not going to take very many people to buy to move price up. So if price doesn't go up, what does that tell you? It tells you nobody wants to buy, doesn't it? Well, it does to me. So if I'm looking at this market and I see, wow, they couldn't even take out 400 contracts, probably not going to go up. This, my friends, is the market actually trading. These trades, let me pause the screen. These trades represent real people, okay? Real contracts. The market is not going up because MACD is overbought or oversold. The market is not going up because of our stupid indicators. The market goes up because more people are putting in orders to buy. The market goes down because more people put in orders to sell. It's just that simple. So as we watch the market trade, you know, we had our pretend trade at 1352. Market came down. Now it's kind of popping back up a little bit. But you can see the actual activity here. Okay, so what I did is pulled in a bunch more history, and so I can scroll back here. You know, you can see there's a bunch of trades at the ask, bid, a bunch of trades at the ask. Now there are some guys who use this to trade, which I'm not going to delve into that right now. But I just want to review. You know, you can see the trades. Right? You can see this is the reason why the market is going to go up or down, because these real people are putting in their orders to buy, or they're putting in their orders to sell. Like there's 50 contracts at the bid, 20, 43, 15. You know, lots of ones and twos. Look, 22, 26, 11. All right, so hopefully this, let me get rid of that. That'll drive you nuts. Hopefully this gives you a better idea of what's really going on here. And if you don't have market depth from your broker, you can get a demo account with MB Trading. Like I said, it's not a recommendation for that particular broker or any broker. I do have an account open with them. Excuse me, one of my corporations has an account open with one of them. Boy, was that just a tongue twister. You get what I mean here. Don't know what I'm trying to like back away from there. Privacy, I guess. Whatever. So anyway, the MB Trading account will give you market depth. You can go onto their website and see what their market depth is actually going to show you. You can of course go to the the CME to get their products. If you have a TradeStation account, then you can whatever exchanges you're paying for, you can look at it there. But I would really encourage you to at least look at a market depth while the market's open, and look at what happens as this bar plays out. Okay, so as we look at this bar, we've got a low and we have a high, and there's the current price, and how does that actually get made up? It gets made up here. These numbers represent real people putting in their orders. Now we don't, on purpose, they don't show you all of the individual orders. They just show you the total number. And you saw for a little while things were getting really fast and lots of stuff was going back and forth, but then look at the bar. It's not really going much of anywhere at all. So hopefully this helps, at least gives you an insight into understanding how the market actually works, how price actually goes up and down, and therefore why we focus so strongly on support, resistance, and we continually ask these questions about who is going to buy. So in our little fake example here, we said, all right, we're going to buy right there. You can see price went down because there were more people that were trading over here at this price. And so price had to go down because these are the prices that are getting requested. Those are the trades that are coming into the market.